I think we can start now.
So, good afternoon to all of you, all our viewers. On behalf of Generational Capital, I extend a very hearty welcome to you on this warm Sunday afternoon. We hope all of you are keeping safe while going through the unlock measures wherever you are. Today, we have Mr. Satwik Jain, Fund Manager of RH Perennial Fund, with us, and he will be taking us through the maiden quarterly results of his fund, while also emphasizing on how to bring a sustained market outperformance while maintaining a low volatility scheme. He will also be driving us through what all stocks he has kept in his portfolio, the philosophy behind it, and also we will be open for question and answers at the end of the session. Viewers are welcome to message us, and we will be taking their queries. So, Satvik, over to you now.
Thank you so much, Vinayak. So, first of all, regulatory disclaimer. So, RH Perennial Fund is a SEBI registered PMS. Any stock mentioned here is not a recommendation, but any sort of imagination, and we can buy or sell even tomorrow. So, all our recommendation or whatever we are saying is just valid till today. So, please consult your financial advisor. And now we'll start with the presentation. So firstly, what our aim is basically. So the purpose of the fund is to compound your wealth. And now, why do we say that? So most of the allocation of Indians is kept into fixed income instruments, which are yielding anywhere between 4 to 6%. Now, and a normal mutual fund that would anywhere compound your wealth between 10 to 12%. Any decent normal mutual fund. Now, what we are trying at Perennial Fund to do is compound your wealth between 18 to 24%. So, just to give you a perspective, at an 18% compounding, in 10 years, 1 crore would become 5.23 crore. And in 20 years, it would become approximately 27 crores. At 24%, 1 crore becomes around 8.5 crore in 10 years. And in 20 years, it becomes somewhat like 73 crores. Now, why are we confident of this ballpark figure is because of the kind of companies which we are investing in. So the average earnings growth of the portfolio over the past 5 years has been around 20%, with a return on equity of 27%. And these are mostly debt-free companies. They do not require external capital to grow their earnings. Compared to the Nifty, where the earnings growth is approximately 9 to 10%, with return on equity of around 10%. So now coming to the performance of the first quarter. So I am very happy to inform you that despite the very bullish market conditions and our portfolio being very defensive, focused mostly into the non-economy facing sectors like healthcare, consumer, and technology, we generated a return of 9.5% versus the benchmark giving around 7.9%. And this was done with lower volatility than the index, as we have been trying to do. So basically, higher returns than the index with much lower volatility in any market conditions. The hit ratio of the fund performed better than the index. Now, again, I would like to re-emphasize the point. This we are mostly focusing on selecting companies which are very defensive in nature, have very less to do with the economy, and can grow their earnings anywhere between 20 to 24%. Now, my views on the macros and the economy. So, frankly, what I advise the investors and my friends and families, we should not get lost in the macro data. We should try to find relevant data, because investing in the perennials and the quality compounders is mostly bottoms up, and we aim to grow the portfolio earnings 20% irrespective of the macros. That's what our aim is. And there is empirical evidence also of that. So over the past 13-14 years, when the index has approximately become 2.5x, more than 60 companies have become more than 100x. So it is possible to find those kind of companies which can grow much faster than the index irrespective of the economy. Coming to the corporate profitability, so the Q4 2020 was one of the best quarters for the all-time high, and this was very much reflected in the earnings of the portfolio as well as of the overall companies in general. COVID and demonetization have led to a massive deleveraging exercise across all the corporate India. So most of the corporates are now trying to reduce their debts or have already done that. And whatever expansion they are doing, they are trying to do it through their internal accruals. So now, what does it mean for the portfolio or general portfolio construction? So there would be massive consolidation across sectors with companies having execution power and market dominance. They would take away majority of the market share across all the sectors. Coming to a few sectors, so I frankly feel this decade would be the decade of technology. Technology is in the midst of a multi-year bull run. By technology, I mean both the old economy IT services as well as the new age platform businesses. And I would not be surprised if 10 years down the line, we have 50% of the Nifty made up of technology companies. Coming to our portfolio, which is broadly divided into growth and defensives. So the growth part of the portfolio, technology and financials did well, uh, supported by strong earnings growth. And in the defensive part of the portfolio, which is pharma and consumer stocks, mostly the FMCG and the highly valued stocks, they did not perform as well, but it's just a quarter. Whereas the pharma basket did well, especially the new small and mid-cap healthcare companies which we had bought. So now these are some of my views in the future as to how we should invest for the next decade. So as I mentioned previously, 10 years forward, everyone on the street would be a tech analyst. Currently, Indian GDP is around $2.8 trillion, and the market cap is roughly touching 3 trillion. By 2030, if we grow anywhere between, the ballpark figure, which is 5 to 7-8%, our economic GDP would be 5.5 to $6 trillion, and the market cap would be same. Now, from this 3 trillion to 6 trillion, the incremental market cap, most of it, I can say with confidence, as high as 90% of it should be added by technology companies. And we have already large evidence of that. If you see the IPO pipeline, companies like Zomato, Policy Bazaar, Nika, all of them are going to list very, very soon. Another interesting factor is these are not irrelevant companies. Swiggy and Zomato have more than 4.5 lakh delivery partners, surpassing the likes of TCS and India Post. So Zomato and Swiggy have more employees than TCS and India Post. So you can imagine the significance they have on the employment generation and the economy. Having said that, most of the unicorns and the decacorns are loss making currently. So we at the Perennial Fund mostly look out for companies which have sustained track record of profitability, and we would be on a constant lookout for companies which are generating profits and are expected to generate high ROICs. Coming to consumer tech, a lot of unlisted new D2C brands like Mama Earth, Sugar, Boat will emerge through decentralization from horizontal e-commerce players like Amazon and Flipkart to vertical ones like Nika. And there would be some interesting IPO opportunities in India. Coming to pharma, this is a mega trend which I like a lot. The Indian contract research and manufacturing space is where the Indian IT was in the early and the mid 90s. With so this is basically due to the value migration from Boston to Bangalore due to global innovation and Indian costs. Just to give you an example, a decent PhD, high quality English speaking scientist for R&D, pharma R&D in India would be available at $40,000 to $50,000. In China, it would be, if I'm not wrong, around $150,000, and in USA it is around $250,000. So the cost arbitrage with same quality of scientists in India is immense, and with high quality English speaking. So I see a very large value migration happening due to this phenomena, with high quality CRAMS companies growing upwards of 20-25% over the next decade. The pharmacy of the world will roar again. So India is famously called the pharmacy of the world, with every 1 in 2 generics in US being manufactured by an Indian manufacturer. Uh, my research says that most of the pricing power in US generics the pricing issues have bottomed out, and all the US FDA issues are more or less factored in. So what we at Perennial Fund are trying to find those dominant franchises in India, which have around 60-70% of branded formulations in India, and around 20-30% exposure to US market, which will give them that alpha and the EBITDA expansion. Coming to the financial services sector, there will be massive consolidation across the whole sector because of the issues which have happened in the past. The tier 2, tier 3 companies will find it very tough to raise good quality equity or debt capital, and this would lead to the gap between the top and the mid to bottom ones expanding. We are very underweight on financial and are allocated to the best quality bank and NBFC only to take advantage of the same, which I'll tell you at a later stage. So briefly talking about our philosophy as to how we try to identify the great perennials which will compound our capital over the next decade. So in most sectors globally as well as in India, profit pools are getting concentrated in the hands of a few champion perennials. So now we are trying to find one part of the portfolio would be in established monopolies which have dominant market share and are growing in double digit. And the other part of the portfolio, we try to find small to mid cap perennials which are emerging monopolies in their sector and taking away market share from the unorganized player to set up their own monopoly. So if we see the global trend in the global advertising business, Google and Facebook have a monopoly. If we see the Chinese job search market, 51 jobs has a monopoly. If you see their food delivery market, Meituan Dimping has around a 70-80% market share. So trends are global. Those trends can be visibly seen in India. Just to give you an example, what happened in a 51 jobs from 2001 to 10 is happening in a Naukri.com right now as we speak, as it is establishing a monopoly in its own sector. So we try to identify those global trends and try to find those monopolies and then try to allocate capital. Now I'll just try to show you our process as to how we try to identify those great businesses. So firstly, we look for great companies with consistency of growth and economic profits over at least one GDP cycle out of the 5,000 plus companies which are listed in the universe. Then we try to narrow down the universe on the basis of our proprietary fraud search and forensic accounting tools. And you will be surprised to see that only 80 to 90 companies clear our checks. Now, out of that, we try to look for sustainable competitive advantages as to why this company would protect its returns on capital and why no one can barge into its castle, basically. And from that, we make a portfolio of 15 to 20 champion perennials. So now, how do we identify clean accounts? You must be wondering about it. So frankly, a famous US fund manager said there is only one way of writing honest accounts and infinite ways of manipulating them. So from my investment banking and the buy side days in my previous avatars, having worked closely with companies trying to raise equity, I figured out some checks and balances which should be done from our end, sitting on the entrepreneur's seat, to get into the mind of the entrepreneur who we are investing in. So the basic aim of a listed company now is to increase its share price. Now, how would it do that? It would do that by increasing its sales and increasing its profitability, whether it is there or not. So, for example, if the sales grow at 10% and the market is factoring in 15%, uh, a not so high quality company would try to show a 15 to 18% sales growth only, and but it will have an equal increase in receivables. So we try to check for higher receivables. Either it hides that money into receivables, or it will put that into inventory, or it will show fake capital work in progress, or fake plant and machinery. That will lead to a depressed ROC. So these are some kind of checks and balances. Another interesting factor I have seen across many companies is they would put fake cash on the balance sheet. For example, Satyam, since it is already a declared fraud outright a long time ago, so Satyam has a 0% cash yield. When you see their books of accounts from 2002, 3, 4, whereas a high quality financial company like a Piramal, so it had a 6% cash yield in 2010 when it had done divestments. So these are some kind of checks and balances. Uh, Now, how do we identify the quality and the integrity of the management? So, when we are evaluating a common stock and we are partnering with the entrepreneur by investing along with him, so the management is 90%, industry is only 9%, and all other factors are 1%. So, this was said by Philip Fisher, and I couldn't agree more with him. So, oh, from whatever mistakes we have done over the past 7 8 years by investing in companies with not so high quality promoters who show their true colors in bear markets, we have developed a 150 keyword fraud search, basically to check the ability and the intent of the management. So just to give you an example, we will go into the promoter history, the size of their unlisted companies, how their family treats the company, what their lifestyle is, whether they are owning private jets, they have a lot of political connections, what are the court cases and litigations against them, then whether there are many CXO level exits at regular intervals, whether the auditor is made to resign very quickly and at a very fast pace. Now you must be thinking, what is the use of all this? So without taking names, I'll just give you a few examples. So a marquee FMCD company from a renowned business house, it is a cash rich company, but it is still taking loans from the promoter entity at 28%. And it is a very prominent favorite of the market. Leading QSR chain, which has been a huge wealth creator, has been pledging shares, putting money into its loss-making businesses. So that is not good on the part of the promoter. So the market doesn't realize this, but sooner or later these things can hamper the share price. Uh, so now, after this, what is the quadrangle of wealth creation? The company should be a big fish in a big pond. It should be a dominant franchisee, and the scope of opportunity should be large. Just to give you an example, for example, Titan's Tanishq business. It has around 18-20,000 crore sales figure. The gold jewelry industry is 3 lakh crore, and still Tanishq is growing at around 15-20%. So we are looking at those kind of businesses. Then reinvestment runways. So essentially, we classify business only into two categories. One are reinvestment modes. For just to give you an example, it would be like a factory. Suppose I have a factory. That factory is giving me 25% return on capital. Now, from that 100, I get 25. That 25, I again invest to put another factory, and then it is giving me 25% return. From that, I put another factory. So essentially, whatever the capital I generate, I can allocate it back at high returns. So these are companies like Relaxo Footwear, DMart, Tasty Bites, which can reinvest capital at high ROIC. Another kind of businesses are capital light compounders. These are like increasing fixed deposits. So first year the FD is giving you 8%, the next year 12%, the next year 10, and then 12. So these companies do not require capital to grow, but we keep lower allocations to them because we do not see very fast growth in them, and also they have to pay back dividends, whereas we like companies which reinvest into growth. These would be companies like an Abbott India or a Nestle or a Hawkins Cookers. The management I told you about, but another important factor about the management is the capital allocation and distribution. So if the management can invest into the business at high ROICs, it should do that. But if it cannot, it should pay it back to the shareholders. It should not keep on holding the cash on its books. And finally, identification of the competitive advantages of the businesses. So essentially, we try to look at 4-5 qualities based on the global investing experience. I have tried to figure out some trends. So just to give you an example, Naukri.com I told you about. So network effects play down in technology companies. So for example, if you are on Zoom, if your friend is on on Facebook, so the another friend, if he wants to join a social media site, he has to go onto Facebook only. He can't go to some XYZ social media platform because another friend would not be there. The same is the example with a WhatsApp, because all of us are there, so an incremental user also has to come there. We see these kind of trends happening into Naukri.com over a period of time, not from now. You can say from early 2000s, when Naukri expanded to the Gulf countries, then it did the famous Hari Sadhu ad. From that time, it acquired market share. Right now, Naukri has around 8.5 crore CVs on its platform. So for any mid-level job, basically the nearest competitor has, I think, less than 1 crore CVs. So no one is near Naukri.com also. I think Indeed came, Google came, Monster came, all these big MNCs who are successful abroad, they came, but no one could keep a check on the moat of Naukri because of the dominant position it made. So now what happens? Naukri has around 50% plus EBITDA margin from this this business. It is a cash cow. It uses that to invest into early stage startups. Some of their successes have been companies like Zomato, which I think they bought around a 50% stake at 100 crore. Right now, it is going for an IPO at, I think, around 35-40,000 crore valuation. So now this is an important part. This company doesn't have a reinvestment mode, but the management is so strong that they can reinvest that capital back into other startups. Next is a low cost producer in a commoditized industry. So just to give you an example, a global company which has been there from early 1980s are like Costco and Walmart. So what they essentially do is they keep their stores very normal, very fringy, and you might not see them very attractive. But but what they do is they keep the costs under control, which is very important in grocery retail. They put a store in an outside neighborhood, then they operate a hub and spoke model, whereas they will keep 4-5 stores around that so that they get the power of distribution. In India, no one was doing it until DMart came. So DMart came in the early 2000s. Before that, all the retailers which I have looked into, they have done huge, massive expansion. If you look at others like Future. You look at Subiksha, which became bankrupt, or for that matter, Future also became bankrupt. They did massive hyperscaling, but they could not keep costs under control because they were not following the hub and spoke model. So DMart, obviously, it is being run by one of the smartest men on the street, Mr. Radhakrishnan Damani. So they did this model by seeing what the trends are there globally. So now finally coming to the consumer switching costs and intangible assets. So I had talked to you about the mega trend, I feel, which is there for the next decade, which is the contract research and manufacturing space. So globally, there is a leader by the name Lonza, which is listed in the United States. So what happens is an innovator like an Abbott or a Novartis or a Sanofi, if they generate trust with Lonza, so they would not shift to any other contract research and manufacturing company because they know that I have trust with them. They have my IP, and I can trust them with the manufacturing process. The same trend I'm seeing happening with companies like Syngene in India. So Syngene is basically providing a platform. It has end-to-end services, right from research to development to manufacturing, whereas most other companies are operating in bits and pieces, and it is the largest. It is managed by the Biocon promoters, which have a very long track record of high reputation and integrity. So I'm fairly confident on these kind of patterns repeating here. So finally, our do's and don'ts of investment. What I do, I told you, but what I don't do, that is more important. So I would never ever invest in companies not earning economic profit. Essentially, companies having ROEs less than 15%, because we think of ourselves as silent partners of the entrepreneurs running the business. And I would never try to run a business where I'm borrowing at more cost and the company is returning less than that. Normally, we try to avoid businesses having dealings with government. So essentially, any G2B or a B2B businesses, B2G businesses. So why is that? Because the receivable cycle goes for a toss, and when the economy or the markets are not doing good, so we can see very huge write-offs. So essentially, all the infra companies, all the road building companies, all you can say the steel companies, we generally try to avoid them. We would not do any land bank and valuation arbitrage plays. For example, there is an XYZ company listed in Mumbai which has 1,000 crore land in South Bombay. Whenever that gets sold, we will get money. I generally try to avoid those kind of plays. And then finally, in case of financials, we would not go against the market in any scenario. What I mean by that is, in we are fundamental investors, but in financial stocks, especially the lenders, the share price is their currency, because they have to raise capital regularly to fund their growth. For example, a Bajaj Finance did a QIP at around a 4,000 crore rupees per share. 4,000 per share pre-pandemic. Now, imagine what would have happened if it had to raise the same capital in the peak of the pandemic at 1,700 rupees. The dilution for me as a minority shareholder would have been more than double. So if the stock of a financial lender is rising, is falling a lot when the markets are doing good, we try to find the reason, and if we are not confident, we generally exit. So our approach in a nutshell, our core approach would be the clear and emerging market leaders. The first one would be basically the established monopolies, companies like an Asian Paint or an Abbott. And then would be the emerging market leaders, companies basically like a Sequent Scientific or a JB Chemical, which have still a long runway for growth and are capturing market share. So I'll just run you through the portfolio and the changes we made. Just give me a second. So as you can see, we are mostly bottom-up stock pickers. We are not married to any one sector, and this would be very different from what you see with other fund houses, as we have very less allocation to financials, and also very less allocation to large cap companies, and still our beta is less than the market. So how do we do that? Our main focus is on defensive growth. Companies doing well, irrespective of how the economy is doing. The majority of the portfolio, obviously, some part of it would be affected, but ballpark majority of the portfolio should be very less affected by how the economy is doing. So, coming to the companies, we broadly classify them into two parts. The one is the reinvestment modes, and another is the capital light compounders. Coming to the consumer goods part, where we have a majority of our allocation, around 40% of our portfolios into consumer. I'll just run you through them. Astral Pipes, we are very confident on the sector as a whole. The sector grew by around 15% compounded over the last decade. Astral Pipe, I think I have not seen any other company scaling up its operating cash flows at a level at which Astral Pipes did. It is estimated over the next decade also the industry would grow at around ballpark 12 to 16%. Astral Pipes, being the dominant leader in the CPVC market, should grow upward, compound our capital upwards of 20%. Though the valuations are rich, but it is getting into other sectors also. So after establishing a dominant position in the pipes business, Astral went into the adhesives business, where also it is doing pretty well. It is even capturing some market share from the best of the best, which is Pidilite industry. Now it has gone into the tank segment, where there is very less competition because Syntex is virtually out of the business. Then there are some high quality businesses with reinvestment modes, like a Relaxo Footwear, which is doing a 150 crore capex. We expect it to compound its earnings between 15 to 18%. Asian Paints, DMart are there. Then one new addition we did in this quarter was Tasty Bite Seatable. So I'll just give you a thesis around that. So it is a small cap company. I think ballpark $500 million. It makes ready to eat organic foods, packaged foods, which is mostly exported. Around 25-30% of its revenues come from its India businesses, where it supplies the the patties and the buns to these KFCs and McDonald's. Now, what happened in Tasty Bites? In around 2018, Mars. By the way, Mars is one of the top 7 global FMCG companies. It is, I think, the size of Unilever. So they acquired Tasty Bites. Now, what I am seeing is, first Tasty Bites was only into the US. Now, given the distribution of Mars, Tasty Bites have already started expansion into UK, Germany, and other countries. Now, how I foresee is Tasty Bites is one of the few consumer companies in India which over the past decade, past 15 years, has grown its sales, its earnings by over 20%. And it has reinvested its capital at a 30% ROIC. So it is one of the largest wealth creators over the past decades, and it is still a small cap company. Now, Tasty Bites had a 90 crore gross block till now. 6 months back, it announced it will be doing a 150 crore capex. 90 crore in the whole journey of the company, it is doing a 150 crore capex. So, and it does a 30% ROIC, and it can do at least a 3-4x fixed asset turnover. So I see massive hyperscaling potential with Tasty Bites as it does the Mars distribution helps, as well as it expanding into other geographies. Coming to our healthcare part, some of our reinvestment modes are companies like Dr. Lal Path Lab, which is the leader in the diagnostic space. It is making good inroads into the East space. However, the issue I see here is the valuations are very, very, very stretched with most of these consumer and some healthcare names. So the future ROEs for us as investors might be less, because in steady state, these companies will grow at around 15 to 18%, whereas the valuations are at around 70, 80 price to earnings. Coming to the next portfolio hold, so this is Sequent Scientific. So this is one of I think only two animal healthcare companies are listed into India, where Sequent is dominant monopoly in the albendazole API. So it supplies globally and it has a significant market share there. How I foresee Sequent is, after the acquisition by KKR, Sequent should grow its sales at around 15 to 16%, and its earnings should double every 3 to 4 years with high ROICs, leaving us good upsides. Then in the capital light compounders, we have companies like JB Chemical and Pharma. So this was being run by the very reputed JB Modi Group. Now the acquisition happened by these private equity firm. So now what they are doing, they are now becoming very, very aggressive. So JB Chemical has around 89% of its revenues from the Indian branded formulation business, which is more or less like an FMCG business, growing at 20% and having high ROICs. It doesn't require capital. Uh, so it is a very, very good cash throwing machine. So just to give you an example, JB Crore right now has around 700 crores of cash on its books. It is generating 350 crores of free cash flow every year. Now what the new management is doing, it is making heavy inroads by filing ANDAs into the USA, and we see it has around 5 brands which are super brands. If we can do a couple of more abroad, then there is a huge scope for re-rating in JB Chemicals. Now, finally, into the last two sectors, technology, Info Edge I told you about. The Nasdaq ETF, we hold around a 6% weight into the Nasdaq ETF because we can't directly buy the listed technology stocks in the USA. So it is a very, very good proxy, and it reduces the portfolio beta also. Then we have L&T Infotech, which is the fastest growing mid-cap IT company in India. Its Mosaic platform is receiving very good traction, and it is capturing market share from the tier one IT players also. So in LTI, I see scope for valuation re-rating as well as earnings compounding also. Along with that, why I like the mid-cap ITs, because they can somewhat reinvest their capital back into the business, into scaling up their technology platform or hiring manpower. So LTI reinvested around 60% of its capital free cash flows back into the business, compared to the tier 1 IT, which can do only 10-15%, and it has to give the rest back as dividends. And finally, in the financial services, we have only two companies. We have around a 9% weight. So the first one would be Bajaj Finance, which is the pioneer of the consumer lending in India. It is one of the largest wealth creators over the past decade, and over the next decade also. I see it easily growing at around anywhere upwards of 20%, simply because right now it's around 2% of the whole credit market. It has the managerial efficiency. It is now transferring from old age NBFC to a fintech platform with the launch of its the 3-in-1 app, and it has very, very strong underwriting processes. So just to give you an example, right now it is focused on risk that and not on growth, whereas the other the smaller ones and the lower quality ones, they are always focused on growth irrespective of the market condition, and that leads to their downfall. And finally, Kotak Mahindra Bank. Why we like it is because of any loan of a significant size, above 500 crore, any corporate loan, Mr. Uday Kotak directly foresees it. Uh, so the underwriting processes are very, very, very strong. The CASA ratio is around 60% of Kotak Mahindra Bank. I think it is the highest in the industry. The second highest is of J&K Bank, which is a public sector bank. And what we like about it is a couple of quarters back, now Kotak, Mr. Uday Kotak also said, now since the risk is under control, we are focusing on growth. So we expect it to compound its revenues and earnings in high teens, and it should provide a good defensive positioning to the portfolio. So that was all from my side. I hope you guys are not bored. And now we are open for a Q&A.
Right. So thank you, Satwik, for your insights into the RH Perennial Fund. I hope we are getting a lot of queries from our viewers. Do you need a 10-second break, or should we just jump to the questions?
Yeah, just a 10-second break.
So yeah, I'll just keep the questions coming in, and how we can kind of position is first of all we'll have questions on your portfolio breakup, and then obviously we can get into the specific stock specific queries if any.
Right. Yeah, so I think we can start them.
Sure. So the first question that I am getting is primarily, although you've explained that financials does not maintain a big weightage in your portfolio, this is quite an outlier as compared to other mutual funds or other entities in this space. So why this sudden why this low weightage on financials and having only two stocks in the portfolio?
Right. So, to give a long answer, I will take you 100 years back. So, for example, Benjamin Graham, when he started investing, so he started in the Great Depression, when stocks were very depressed in valuation. So, his framework evolved towards finding value stocks at low price to earnings, low price to book. Same way, Warren Buffett started his investing uh, in the early mid 1950s, 1960s, and he evolved towards finding great businesses because the economy was like that towards then. So when I started my investing, I'm nowhere comparable to them. But when I started my investing in 2013, 14, so I experienced the bull run in financials, the NBFCs. But the drawdowns were very, very severe. And that time I realized that lending financials are very, very much related to the stock markets and the economy. So for example, if the markets are not doing well, so they will not be able to raise capital also, uh, be it equity or be it debt, and there will be defaults from the people who they have given money also to, because generally that time the economic situation also would not be that great. So this, then I realized that when I am looking at the equity markets and I am finding other companies which are compounding and doubling their earnings in every 3 to 4 years, so why do I want to take this sort of stress into the funds? And since our family's significant savings are allocated towards their fund, so I do not want to look at this kind of volatility. Another thing is, uh, say a Bajaj Finance being a 5x over the past 3 4 years versus a DMart being a 5x from then. There is a massive difference. Uh, Bajaj Finance would do that with a lot of volatility based on how the markets are doing, how it is being able to raise capital, and a consumer company would do it in a very smooth way. So now my constant endeavor is to find those kind of company which give me basically compound capital, double it in 3 to 4 years, and are very, very low volatile in nature.
But do you see any consolidation happening in this sector due to the maybe conditions or however way the due to COVID waves and all? And do you think that your low once this consolidation is over, do you think Nifty will be outperforming the fund because they have a 37% weightage of financial stocks? And don't you think there might be underperformance by RH Perennial? due to that?
Right. So first I'll answer the question on the consolidation in financials. So if we see what happened in the Asian, so I always try to find trends in the past because they will repeat also in the future. So if we go back to the Asian tiger crisis, which happened in the 98, 99. So I think there were around 4,000, 5,000 NBFCs at that time, and only a handful of them were left. Even the top tier nifty companies which had opened their lending arm, they had to shut shop because financing wasn't there. A similar trend I am seeing here. So in the mid 2015-16, when the new BJP government had come and there was signs of prosperity and optimism all around, a lot of NBFCs had opened up. But after the Franklin fiasco that happened, credit was scarce, liquidity was almost none. So most of them have shut shop now because the credit demand will be there. If the Indian economy has to grow at 7-8%, the credit market will grow at 1.5, 1.6x of that. So now that market share will be captured by lenders who are able to manage their risk. How I see is Bajaj Finance and Kotak Mahindra Bank are the best place to do that because the other high quality ones which I see, either they are only regional focused or the other ones are basically not earning high ROE, so they have to dilute equity again and again. Now coming to the underperformance part, so just to give you an example, the quarter is a very small time frame, but still we outperformed the index. But having said that, we are pretty much okay with an underperformance in a raging bull market when all the commodities, the steel stocks are doing well, and we are okay with underperformance as long as our capital is safe and the portfolio is compounding its earnings at 20%. Because when the cycle turns, normally, like I would not have an idea as to when to exit a cyclical stock, be it a graphite stock, a steel stock, or a sugar stock. But with these kind of companies, I can keep on holding them. And for that matter, when the broadly the portfolio is divided into two parts. So you can take an example of a cricket team. So one part of it would be a Rahul Dravid, so which is having like your Nestle's and your Abbott India's, and the other part would be like a Virender Sehwag, which are high growth hyperscalers. So these will be companies like Astral Pipes, which are going at 40% plus. Companies like Naukri.com, as tech is the leader of the bull market, so they are doing very, very well there, and most of the liquidity is chasing them. So these high growth hyperscalers, so they would take care of the portfolio in the bull market also.
Right. I think that answers our query. There is another query that is coming up, that a lot of blue chip companies are run by one major industrialist or one family patriarch who is there, who act like the face of the company and the vision, and they kind of dictate what is going to happen. So, how do you see, once these management is gone or there are management changes, how do you know that the company will have a secure track even after the major management phase is not there or the next generation comes in? So, any tips to our viewers on how to identify such companies as well, who will not be solely dependent on management?
Right. So what I have seen over studying over how wealth has been created over the past. So normally the companies become more professionalized, and professional management takes over. So you take any wealth creator over the past decade. So I will just give you an example. So for example, Polycab. So that is not in the portfolio. We are not holding it. So earlier it used to be run by the promoter family. Now they have got on board a high quality management professional. The promoter and their sons are still, in the company very much actively. But those quality management professionals are there. Boston Consulting Group, McKinsey has been hired to develop the framework. So, and also as a part of our investment due diligence, we try to see. As to if the promoter is not there, the single man, then how the succession would be there. So normally, what we see is the next generation takes over, but there is also a professional management who would be mostly qualified MBA, CAs with rich industry experience of over 15-20 years. who were there with the promoter and are now also scaling up with the management.
Right, right. So another quick question here. Would you pick a debt-fueled growth stock who is growing at 30% per annum, or would you pick an asset-light compounder at 18%?
So the answer would be somewhere in between, if I say. But obviously, in between these two, I would also always prefer an asset-light compounder growing at 18-20%. But more than that, I would prefer a reinvestment mode compounder, which is basically generating cash flows and can reinvest it back into its business and growing at 18-20%, because that would create the actual intrinsic value, and over the long term, that is how wealth would be created for the company and for us. So as I told you before, we do not invest in companies which are earning ROEs less than 15%, as a rule. Obviously never say never, but this is a general rule. So any debt fueled growth, that would not be preferable to us. In fact, that is the main reason why we have so low allocation to financials, because if you see all these tier 2 banks and tier 2 NBFCs, they are having an ROE of 12-13%. In a good bull market, they would be growing at 40%. So they are always on the street to raise capital, and when capital is not there, then the cycle turns, and then they go into liquidation, acquisitions, or whatever.
Right, right. So, coming to the risk in the portfolio, do you maintain a stop loss on your investments, or how would you look at minimizing the risks of an underperforming stock when maybe a call does not perform as you have expected it?
How I foresee is, I do not watch, frankly, the day-to-day stock price movement. How I foresee is, if the growth stops. So if I had bought, say, an Astral Pipes for a 20% growth, and if the growth doesn't come in, then I get sleepless nights. Like, then I have to make a call whether I have to exit that stock, or I have to stay put. So that gives me sleepless nights. Apart from that, regarding the stop losses, so no, we do not maintain stop losses. And normally we have a fairly diversified portfolio, because you can safely assume 90% of my wealth is into my fund. So I have tried to make a safely diversified portfolio. We have around 18 stocks. We also have Nasdaq, which reduces the beta. So normally, our highest allocation would be around 7%, and the lowest would be around 3%. And how we also try to allocate is, so one of my mentors had taught me, and it is still in my brain. Mr. Ashish Kila had told me, buy on the basis of upside, but allocate on the basis of downside. So our highest allocations would be companies where I'm pretty sure I would not lose money. So our highest allocations would be companies like, say, Nestle, Asian Paint, Relaxo Footwear, whereas I know I might not make a 20-25% compounding, but here my money is safe. And lower allocations would be companies, the small cap companies, like Sequent Scientific, JB Chemicals. So that is how I try to position size my portfolio.
And do you also, what is your position on keeping cash in the portfolio? So, do you believe in having that on the sidelines for maybe an
Right, right,
expected
right. So,
correction?
so, so I have been in the market for past 8 years now. I have been 100% invested since then. I have never ever kept cash. So, in the fund also, you would not be keeping cash, because the opportunity loss can be huge. You are sitting on cash, and you can miss the opportunity of a lifetime, because we are trying to find those hyperscalers. So, what if I'm sitting on cash, trying to find that dip, and the company becomes 10x, because those are the kind of companies which we are trying to find out, which are the fastest growing in their sectors, and growing with their internal accruals.
And also, I believe the fraud check and everything that you do is, anyways, acts like a natural hedge, in ensuring that the opportunity does not go wrong.
Right, right, right. Yeah. So basically, evaluating any company, a new company, takes around 3 to 4 months. Reading around 10,000 pages across Google and annual report, DRHP, meeting the distributors, doing site checks, doing industry connects. So it takes a lot of time. So as it is, we are very slow to allocate companies. So normally in a given year we would buy or sell one or two companies only. More or less, rest of it, the portfolio would remain same as long as the growth continues.
Right, right. Also, what about interest rate hikes? So Fed has signaled that the interest rate hike would come instead of 2024. They are expecting it to come in 2023. Although the economy has been responding. So do you think that would that result in any changes in your portfolio or any kind of remodeling as of now?
So frankly, if we see over any, 5, 10, 15-year period where the investors who come to me, they are allocating capital towards me, it won't make difference if we are finding those companies that, growing, basically doubling their earnings in 3 to 4 years. Having said that, US is a very mature market. The Fed there is a very, very mature market. So they gave soft signaling that basically the rate cutting cycle might be over, but we would not be raising it in a jiffy. So because the issue is the developed market is in such a lot of debt that if they raise the interest rate, US alone I think would have across, I think, around 600 billion incremental payments to be done if 1% rates are increased. So I don't think they would do that very fast. And even if they do that, through the companies we are investing in, they do not require external capital. They would grow, do their own profits and reinvest it back in their business. So it hardly affects the business as a whole. So I think that should be the same implication towards the stock price in the medium term.
Right. Now, there are some specific stock questions coming to the portfolio composition. So, first of all, the first question I would like to take is on Tasty Bites. So, what one viewer is asking is, Tasty Bite Eatables diversified significantly from its mainstay of ready-to-eat products that are only exported. Because of this, now they are competing with all major players in the industry. Isn't that a risk?
Right. So my thesis is at the scale, if it is, I think around 150, 200 crore, whatever that revenue is, and given the size of opportunity is and the power of distribution which Mars has, so scaling up its revenues 5, 6x from here shouldn't be an issue if that happens. And over the past also, Tasty Bites has been doing a 30% ROIC, which is very, very rare, along with 20% growth. So even in the base case scenario, that continues. Still, we are doing pretty much okay.
Right. And another question comes, it's relating to the Nasdaq, that the Nasdaq is heavily concentrated and also consists of a lot of pre-revenue and loss-making startups. So won't the S&P 500 be a better proxy to have because of this problem in Nasdaq?
Right. So around 53% of the Nasdaq is into the FANG stocks. Just to give you, I think, some broad numbers, they are trading at around 21 times the price to earnings. Their last year earnings growth was 40%. Their ROIC is crossed around 70, 80%. So that is majority of the portfolio, which is the monopolies. You can say the ultimate monopoly. Some companies as big as the GDP of India, like Amazon, Apple, Facebook, is there. So that will be majority of the portfolio, but yes, some part of it would be into those kind of companies. But I think here the main thesis was I wanted to get exposure to the tech part, basically the platform play, because in India not a lot of platforms are listed. So one I got exposure through the investments of InfoEdge, which they are investing into the emerging platforms, and they are one of the best into the business. Apart from that, for a platform play, I wanted exposure. So, and this seemed the perfect proxy towards that. The
Right.
S&P 500 would have been there, but there are two things. Firstly, the ETF is not there, so in my fund I can't buy them. And secondly, it's too diversified. Given my thesis that tech should do well.
Right. Also, we don't see Davis Labs. I think in the CRAM sector, it is also a clean leader. So, any specific reason for
Right. So I would not delve much into that, but with some pharma companies, we could not find the management quality to what I like. But this has been one of my biggest regrets also, that sometimes there are gray areas that some things are not absolutely clean and like not black and white, and you have to take a call, and that's where I have missed many wealth creation opportunities. So divis is one of my biggest regrets, divis and pi basically.
But at the end of the day, if you are compounding at 18% or 20% portfolio, then I don't think the clients would complain.
Yeah, that is there, but obviously if you miss opportunities you feel bad, and these are like proper sharks in an ocean, or like big fish in a big pond where they're monopolies and still growing at 20%, and they can reinvest their capital at high ROIs. So these are perfect businesses which fit our framework, but sometimes you tend to miss them right into plain sight. But it is what it is. So there are a lot of regret, but we have to stick to what we own and focus on them.
So are you also considering any other sectors like maybe infrastructure sector with 5G, lot of discussion on 5G happening, or maybe a packaging sector with investment into SL Propack or Uflex, how these companies have performed in the last 1.5 years. And so do you think these sectors will also be an important play in the economy, or in fact in your
Right,
portfolio?
right. So especially toward the infrastructure, general growth in the sector does not mean the it creates stock market value. So the telecom sector did hyperscaling from early 2000s, but only like no one made profit because it was a road to zero. Airline industry, the volumes grew some crazy numbers over the past 20 years, but I think still only one player is there, and that also is not making profit on a regular basis. So it does not mean that if an industry is growing, the companies will make profit. We have to see the underlying unit economics of the business, and here most of the business is done with the government. So I am not very comfortable in businesses which do business with government, and this you can see in the receivables days of most infrastructure companies, where 80 to 90% of the sales, even of the best of best, the number 1 2, are into receivables only, and cash is received much much later. And we do not know whether that receivables are real or fake. And one fine day that infrastructure company comes and does a massive write off at the bottom of the bear market. That is what I'm very fearful of. And since our family's significant money also is allocated here, so that is why I don't take those kind of risks.
Right. In fact, we have also seen that in a lot of roadway stocks with Noida toll collection and these companies, the revenue is not, you cannot kind of predict how it will come over the long term period of time.
Right. So again, like I would try to reiterate, a socialist is not a capitalist. Like, although never say never. Like the PSUs made a lot of money over the past 5 years. I might also buy into PSU some years down the line. But what I have realized is, a socialist, like a government, they are not of the capitalist mindset. So, and Uday Kotak, he has a significant net worth into the Kotak Mahindra Bank, whereas the MD of a public sector bank, he's getting that few lakhs of salaries, and his incentives would not be the same as what an Uday Kotak is. And he is Asia's richest banker because his significant wealth is into his own, the stock only. So this is where the incentive alignment is not there, and all we have to always see the power of incentives with these public sector enterprises, and that is why they have not been doing well. Having said that, they are very high quality assets also, like all these Concor is there, BPCL, HPCL are there, but I would right now stay away from them, but again, never say never.
And what about a monopolistic business like IRCTC? The stock has been doing great in last 2 years since listing.
Right. Yeah, so IRCTC I have tracked a lot, but again, like just again, it is one of my regrets that just because it is a government business, I am not investing there. Another thing is like it cannot reinvest its capital back. So, but it is a very great business, IRCTC, that way.
Right. Another specific stock question is coming for DMart, that they have significantly invested into real estate. So with shopping moving a lot online, don't you think they are sitting on huge risks?
Well, DMart, I think it is one of the very few companies which can grow at 20 plus percent and also reinvest significant part of their cash flows back into the business. So right now also DMart has what, around 200 odd stores. The size of the opportunity is immense. It is right now what, not even 2-3% of the whole organized retail market. So in USA also, if you see the trends, after Amazon came, all these online shopping came, these Walmart and all were doing pretty good. Walmart and Costco. So obviously both have their own space.
Right. And what about HDFC Bank? Given the retail hold that they have in the market, we still don't see it figuring out
Well,
in your
so
portfolio.
again, this is no stock recommendation of any sort, but the issue I see with this bank in especially is in India over the past 40 years of what I have read is no one has made money into wholesale lending basically. So HDFC Bank was a retail bank in the past, but right now it has around, if I'm not wrong, 55 to 60%. Don't take me on my numbers; you have to check it, but around 55-60% of its book is wholesale. Now, going by the previous trends and what has happened in the past, it is very, very tough to make money into wholesale because you will get good, good NIMs initially, and one fine day when the cycle is bad, some real estate developer where you had a big chunk that will default. So that is why I stay away from HDFC Bank. That is why I said I'm like very, very conservative, like very, very, very. Well, I am not even having HDFC Bank for HDFC or HDFC Life.
Yeah, any no group company of HDFC also is making any figure in the portfolio. So
Right, right, right. So because frankly, insurance I don't understand. And HDFC was purely an NBFC. I thought Bajaj would be better, so that was how the allocation was.
right. What about specialty chems? There's a pretty strong tailwind, and the numbers are also showing
So
it.
right, right, right. So I do not understand. So over the past 1.5 years, I have been working towards understanding it. But frankly, I have not been able to understand that. And in the companies which I understand, so they are doubling their earnings in 3-4 years. So I was like, okay, if I'm not understanding it, it's okay.
Right. I also understand that they come with a lot of raw material fluctuation risks and fire and all that can happen. Some chemical
Right,
players have
right, right.
reported that.
Yeah.
So
So
that
if
might.
you see that like an Asian Paints is a chemical business only at the end of the day. So we have that exposure, but generally we do not understand, so we stay away from that sector.
Right, right. And finally, one question that every stock market expert is asked: what would be your Nifty target for the coming year, and what would be your return target on your portfolio?
So Nifty, I don't know, but we can safely say with the kind of hard work we are doing, so our portfolio should compound between a ballpark 20%. So in the next decade, you can expect anywhere between a 5 to 8x return. Obviously, there are no guarantees in the stock market, but given the earnings trajectory and the quality of earnings, I think it should be safe to assume this. And
Right,
having set the Nifty target, so what I have seen over the past is Nifty normally reflects the nominal GDP over the long term. In 1 year, obviously, anything can happen. But normally, Nifty should compound at around 12-13%, 6-7% real GDP, around 5-6% inflation. And we should be able to generate, if everything goes well, around 5 to 8% alpha over the Nifty. Over a reasonably long period of time.
and what beta are you expecting the portfolio to have over this period? What is your
Right,
target?
right, right. That is where I am very confident about because we are mostly allocated towards defensive stocks. Basically, our thesis is we should be having defensive growth. Most of our portfolio would be into healthcare, consumer, which are very, very low beta stocks because simply because these are compulsory consumption. They do well if the even if the economy is doing bad, so the stocks also tend to fall less within a bear market. So we expect our beta to be around 0.6, 0.7% and also deliver an earning growth of around 18 to 20%. Though a quarter is a very short measure, even in the past quarter, our beta was around 0.7. So we are confident that we would generate higher returns than the Nifty with much less volatility.
Right. And another question in relation to the building material space, like we have Astral there. So what about wires? I think you answered Polycab was considered, or let's say another like a player like an APL Apollo.
Right. So again, like I really like the sector a lot. So Polycab is there, KEI is there, and Polycab is now transitioning from the B2B space toward the B2C space, where it is doing massive hyperscaling. I think it is one of the fastest B2C players to reach that 500 crore revenue. So we are constantly tracking it, attending their con calls, and then let's see what future holds. So that is our view. Otherwise, we are significantly allocated toward the building material than consumer sector, and it has been doing pretty well for us also.
Right. And any views on APL?
Again, like it would be very stock specific, but since we had Astral, we had comfort on that, so we did not go into that.
Right. Right. So I think we've pretty much covered all of our queries that we've got. And I would really like to thank you, Satwik, for taking out this time and giving us insights on how to build such a risk-free, low volatile portfolio and identifying high earning companies. So I'm sure this would also be helpful to our viewers in trying to understand the market better.
Thank you so much, everyone, for attending. And we would be doing this on a regular basis to basically maintain the transparency, since the industry is such a black box. So every quarter we'll be coming out with the numbers, whether they are good or bad, and how the portfolio has been performing.
Right, right. One last question coming is on gold finance companies like maybe a Muthoot. So they have low beta. So still those are not figuring in.
Right. Yeah. So essentially, if you see, the lenders are divided into two parts. The one is the low ROE, high growth businesses, like most of them are, which require external capital. But gold financing is a very good industry. So basically, both Muthoot, Manappuram, I think one of them has that microfinance unit also, which is not doing that well. They have ROEs upwards of 20% and are growing at 15%. So essentially, they can grow without raising external capital. But again, having said that, that there were issues that higher LTV might impact them, and I was getting other opportunities, so which were growing at similar pace. So, and we inherently do not like lenders a lot, so that is why we gave it a pass. Otherwise, these are pretty solid companies.
Right, right. Thank you for answering that, Satwik. So viewers, we would like to end our webinar here, and we look forward to having you on our future discussions and sharing our insights with you. Thanks a lot. Thank you, Satwik.
Thank you.